Hey everyone, me Kevin here. The Federal Reserve just pissed off markets again. Look, the Federal Reserve released their minutes from their last meeting. This is old news. The minutes aren't supposed to move markets. But now we had the 10-year Treasury spike up a bit from like a low of 1.62 today during the madness this morning to now almost 69, of course, 69. And folks, now the S&P is dipping a little bit. I wasn't going to cover this because I'm like, they're not going to say anything new. It's going to be the same old crap. Well, why then is the market going down, Kevin? Yeah, well, the Federal Reserve tried and failed to provide some comfort to the market by acknowledging what's happening and at the same time suggesting that, don't worry, we're here to help. But the market don't want the Fed here to help. Why? Because when Fed Chair Jerome Powell was talking to Sarah Eisen 2 months ago, Sarah Eisen goes, well, what's on your tool belt? What are you going to use? We all know Sarah Eisen. She gets in there. She asks the right questions. She's on it with those questions. Love those questions. Anyway, Jerome Powell's like, she even pre-answered it. She's like, it's interest rates, right? You're going to raise interest rates, right? Such an awesome question. Anyway, Jerome's like, well, yeah, that is the principal tool we would use. Market falls. Anyway, so let me explain it by showing you. Here we go. All right, so here we go. Fed press release. I talked about this live with course members, and at first the market was shrugging it off, but then they started freaking out a little bit. So yellow is stuff that's pretty much the same, okay? I'm trying to save you time here. I appreciate you. I appreciate saving people time, and this is exactly why you should save time in building your wealth. Oh, that transition, that plug was so good. And use that 39% off coupon code link down below to get into the amazing programs and private live streams. And don't you fear, I will never forsake my course members. We will always be adding new content to these as new content is necessary in my programs. Whether I'm governor or not, I'm adding content. All right, so what do we got over here? COVID-19 pandemic is causing tremendous and economic hardship. That's the same thing they've said many times before. Indicators of economic activity and employment have strengthened. Okay, that's good. So, all right, this pink, a little bit of an issue. The sectors most adversely affected by the pandemic remain weak, but have shown improvement. Inflation has risen. This is the first time the Fed has literally said that. Like, okay, it's happening. Inflation's going up. Yep, inflation is happening right now. This acknowledgement is kind of like, in my opinion, how like mature people are supposed to talk about their problems. The first step is to acknowledge the problem. Yeah, I effed up. But here's what we're going to do now. We're going to comfort you by saying that this is largely reflecting transitory factors. Look, the market does not believe this. The market doesn't care about this. So pretty much all we really got in this sentence right here, since the market does not believe this transitory thing, all we really got is this right here. Look at that. Look, read it now. Inflation has risen. It's like, he is risen, right? Okay, so let's put that back. Overall financial conditions remain accommodative, in part reflecting, well, okay, this is all the same, depends on the course of the virus. The committee expects to maintain an accommodative stance. This was no change, no change, no change. Oh, but what's over here? In assessing the appropriate stance for monetary policy, the committee will the Federal Open Market Committee, the Fed, will continue to monitor the implications of incoming information for economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the Fed's goals. So in other words, we're ready to raise those rates, and we'll make that change sooner if we need to, which is literally what Fed President Bullard said this morning, suggesting that, look, we'll act if we have to. We are not going to sit around and pull a 1967 stunt and sit here twiddling our thumbs for 6 years. If inflation gets out of hand, we'll deal with it. We have the tools to deal with it. Yeah, it's going to crash your stock and real estate market, but that's your problem. Seriously, okay? The Fed, as much as you might think the Fed is here to bail you out, wrong. The Fed only wants markets to function. They don't care if that means function and plummet. It's different. And I know that sounds ironic, but asset prices is not or are not a priority for the Fed. The committee's assessment will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures and expectations, and financial and international developments. Yeah, well, international developments is another way of saying inflation in the international community. Sure, yes, okay, what about tariffs and all that? Fine. But international inflation also matters. But they're also saying inflationary pressures, which would be like commodity prices going up and worker prices going up, labor prices going up, all this, right? And inflation expectations have skyrocketed. But inflation expectations usually amongst institutions are more moderate. That's what you see show up in like the 10-year break even, the 10-year treasury and that. Inflation expectations amongst consumers has risen to like, oh my gosh, we think inflation's gonna be like 4.5%. But consumers are really bad, like it is what it is. Consumers are usually really bad at having proper inflation expectations for the long run because they base their expectations usually on what's happening right now. So it's like, oh my gosh, everything's going up. That leads to, this is never going to end. And obviously we're waiting for that inflection point, hopefully in September and October, where inflation starts trending down. I sound like a broken record, I get it. But anyway, after this happened, we have seen the cryptocurrencies pull back a little bit. I want you, and the indices, I want you to know why. Again, to be clear, the Fed is acknowledging that inflation is here presently. This is really still no difference in messaging from what's consistent. But because they're still saying it's just going to be transitory, the market's like, okay, so basically you're saying inflation is here and we don't believe you on transitory, so you're basically preparing to taper. And the fact that they're saying, hey, we're monitoring the implications of other things going on. If risks emerge, we'll use our tool belt, which, as Sarah Eisen taught us by directly asking Jerome Powell, is increasing interest rates. So increasing interest rates would obviously be something that, quite frankly, like if and when it happens, it's like maybe that'd be the best case scenario. Just raise the freaking rates already. Let people freak out. And then let's go back to a normal market and a party. Because the market's almost pricing in so much fear. Oh my gosh, what's going to happen when rates go up? Well, look at 2014 and 15 and 16 and 17 and 18 when rates were going up. You know, look at when the taper tantrum started in 13. There you go. You know, it wasn't that bad then. The market was fine overall. So I think there's so much uncertainty that people are like, short. Anyway, take a peek at the programs linked down below. I would love to have you use that expiring coupon code before the marketing team streamlines my Teachable website, which right now has a bunch of bundle options. I don't have as many courses as it looks like, but it would be like sales, YouTube, real estate investing, real estate sales, property management, rental renovations, right? And then you can bundle those together in various different groups. But anyway, hopefully this helps you get a little bit clarity on what happened here. And folks, we'll see you in the next one.